I'm Charlotte McLeod with investingnews.com, and here today with me is Will Rhind, CEO of Granite Shares. Thank you so much for being here. Always great to have you back.
Thanks, Charlotte. Thanks for having me back.
Of course, really good to be speaking with you. We're catching up on our conversation all the way back in January, so we've got a lot to go over. Where I thought we could begin today is, of course, with gold. So we saw the price go below 4,000 this week, although currently, as we speak, we are back above that level. There's a lot of factors that are weighing on the metal, but I wonder if there is anything that you would pull out to explain that drop below 4,000.
I think that it's partially due to the resolution or the purported resolution of the Iran war. So some of the geopolitical tensions have calmed down. Oil prices dropped quite significantly. And alongside of that, we've had also some chatter about interest rates rising. Certainly interest rates were kept on pause at the last Fed meeting, but now, depending on what sort of predictor you look at, there are people calling for one rate hike now this year, which is something that 6 months ago was not on the cards at all. So I think we've had a bit of a change around the circumstances, which has obviously led to gold price declining so far this year.
Definitely a lot of changes in those 6 months, as you pointed out. I think a lot of investors are looking at what's happening with gold and they're wondering, all right, we've gone below 4,000. Now we're back above that level once again. Where is the bottom? I wonder if you have any thoughts on that, on where the bottom is for gold at the moment.
Well, I think you've seen the market rally today, and I'm not suggesting that this is the bottom, but it's rallying on the back of the dollar weakening. And, I think that this trend really for the bottoming to occur, the trend, I think, in terms of the dollar cycle has to reverse. In other words, the dollar has to start getting weaker on a more structural basis as opposed to just on short term. And I think that, that has to come with improving macro factors, particularly around inflation and interest rates.
That's leading into exactly what I was hoping to ask you is what is the potential trigger for gold to break out of this zone that it finds itself in right now? So for you, would that be a change in the direction of the dollar at this point?
Yes, I think so. I think that right now, clearly we've been in a very unusual situation over the last period with the war going on in Iran. That's caused a lot of uncertainty in markets more broadly, but I think we're moving beyond that now, and that has led, like I said, probably the most relevant factor has been the precipitous drop in the oil price from over $100 a barrel to now just under 70 today. So there's been a big climb down in the price of oil, and from a gold perspective, I think we now need to focus back on a normal macroeconomic environment where growth is being driven by a combination of lower interest rates and lower inflation. Both of those things right now are going the opposite direction, at least in the US market. And we'll have to see whether this is a short-term factor really again augmented by the war and the higher energy prices, or is this something a little bit more structural?
Yes. And again, that's exactly the direction that I wanted to go in terms of inflation. So you mentioned we have cooling of tensions in Iran. We have oil prices coming down. But I think a lot of people wonder, after so many months now of disruption, how quickly realistically can inflation come down? So any thoughts you would share on that note?
Well, I think that if we talk about gas prices, then they could normalize quite quickly because they are, I should say, quite reactive. So just as it seemed like to everybody that gas prices shot up very quickly. So they're likely to come down quite quickly. And we've seen this before in previous cycles. So that will certainly be a positive to the inflation argument that gas prices are still very high from a historical perspective. And so oil prices or lower oil prices certainly help that factor. And then I think that hopefully that translates just into lower energy costs more broadly, which will help with other, inputs on the inflation side that can also start to come down.
Well, and you also mentioned the Fed, and I think important to mention we have a new Fed chair since we last spoke. Do you think, is your sense that the Fed will hold on to that 2% inflation target under Warsh, or what do you expect to see?
I think that he is so far sort of indicated a willingness to reform or carry out some reforms of the Fed, the current sort of structure and how they communicate with markets. We haven't really seen much evidence of that yet, but of course, just really getting started. So we'll have to wait to see how that develops. But I think that the focus around inflation clearly has to remain important, but perhaps it won't be so tightly tethered to the previous regime. But we'll wait and see.
It definitely seems like we are in that wait and see mode. And I wonder if you have any other comments on Warsh and what we can expect from him through the year. I think definitely from last week's Fed meeting, it seems like he wants to differentiate himself from the Powell regime. So anything key that you will be watching there?
I think the first thing, to the extent that this has already been much discussed, is I think there was a perception that he would lower interest rates very aggressively, very quickly, seemingly because he was the favored pick of the current president. And I think that the market at least has realized that perhaps that was a false assumption, and that we're going to get an interest rate environment that probably won't move that much from here, especially when you have at least 4% CPI numbers as of today, and perhaps it won't be so dovish. So market expectations have changed, and that's why you've seen a rise in yields a little bit and a strengthening of the dollar.
I also wanted to check in with you on your thoughts about the overall US economy. Back when we were speaking 6 months ago, I believe you mentioned it was looking overall in pretty good shape. So how would you update your stance, if at all, now 6 months later?
I think it's the same. The only difference is we've had an energy shock, really, since I probably spoke to you last, in the form of the crisis or the war in the Middle East. So that wasn't something that anybody had predicted, but has had an impact. I mean, clearly had an impact in markets in terms of volatility, uncertainty around that. But most obvious, as we've discussed, has been the energy shock, which has translated itself into higher energy prices for consumers across the board, but most notably, of course, always in terms of gas prices at the pump. The higher inflation print today, I'm sure, is a big factor. That still is a big factor involved in that. And so it will take a bit of time for those prices to come down. But I think that they are more temporary in nature. And again, with markets sort of performing at or near all-time highs, I think markets are telling you that they've largely moved on as well from the Iran war.
Right. And we'll definitely get into overall markets in just a moment. Before we do, I want to get a look at your overall thoughts on the picture for gold. A common theme that I'm hearing from the people that I speak with is that we're still in a bull market. This is a temporary blip as we stay in that larger cycle. So for you, where are we at this time in the cycle for gold?
I think that's broadly speaking correct. That we moved from one cycle, and we're transitioning now into another cycle, and so clearly the conditions have changed that fueled the drive certainly to above $5,000 an ounce. But the broader macro conditions are still largely in place. And some of the key reasons that gold went above 5,000 in the first place are still there. So we still have a debt problem, not just here in the United States, but around the world. We still have a government spending problem. We still have deficit issues. So all of these things haven't gone away. But people will be, of course, looking at the performance of the U.S. economy, the performance of the inflation data more broadly, and then, of course, as a functioning factor, interest rates and the direction of travel for those three things.
Right. I think it's important to keep those underlying drivers still in mind, even though we have these day-to-day factors that tend to steal the headlines. Keeping in line with gold, I want to take at least a brief look at silver as well. I'm wondering, do you see it going on a similar trajectory as gold in 2026, or could it take a different path? Because, of course, it's got its precious and its industrial drivers.
I mean, it could, but it's just tough when it's so highly correlated to gold. And so their paths have been very correlated this year in terms of performance. And of course, most normal years. And so from that perspective, I think it's difficult to see, for me at least, to see how silver sort of truly decouples from gold in this particular environment. But I think key to silver's price, or any recovery in the price of silver this year, really is a recovery in the price of gold.
And so, by proxy, essentially, silver is also tied to the fate of the US dollar, similar to gold.
Yeah, exactly. It's a monetary metal, similar to gold, but clearly has more economic exposure, more exposure to the business cycle than gold does. And so, silver is more affected by the performance of the global economy, and particularly the demand for silver and industry itself.
Of course. And let's go back and take a look at the broader stock market as well. I know many of the people I speak with believe that we need to have a major correction at some point. This has just gone on too long. How are you feeling about the overall health? Does it look good to you? Do you see warning signs? How are you feeling?
I think, again, that there's no real warning signs in my mind. And to me, just because markets are elevated, that in of itself isn't necessarily a warning sign. As long as companies are meeting earnings, so they're delivering on expectations around earnings growth and signaling, more or higher earnings in the future, that's ultimately what the stock market comes down to. You can't control macro factors about whether we're going to have a war or pandemics or anything like that. But if you're talking about just over the long run, companies that are growing and posting earnings that exceed market expectations, that is the environment that we're in at the moment. So it is an earnings rally. I think SpaceX was a watershed moment for markets. There were a lot of bears online in the run up to the SpaceX IPO, saying that would be the top, that the market couldn't digest the amount that SpaceX was trying to put into the market in terms of the float, and that because of that, one would have to sell existing stocks to buy into the SpaceX IPO, and that would cause a big cascadal sell-off. Now, obviously, that didn't happen, which again to me is a sign of strength that the market was able to absorb the SpaceX IPO, and not only absorb it, but actually they ended up absorbing more than the banks initially had signed up to sell. So the actual offering size was increased. So again, I think you have to look at those as healthy factors. The concerns about valuations will remain; they will always linger. But people were saying that 10 years ago, and the market has continued to rally since then. So I think, to me, I only start to get worried about that if it's truly decoupled from what companies are actually doing on the earnings front. And so long as companies are meeting market expectations or exceeding them in terms of earnings, then I think that tells you that the economy is in a good state.
All right. So that's the warning sign that we can watch for in the future, and that could tell us that we might be getting that turnaround. All right. We'll keep an eye out for that. Tell me a little bit more about SpaceX, because I know Granite Shares launched 2 ETFs to go along with the debut into the market. So you've got the short and the long side that people can play with these ETFs. I wonder if you can share where you're seeing the most interest. How are investors approaching this stock?
Yeah, so far we launched SPAL, which is the Granite Shares 2 times long SpaceX, and SNK or SYNC, which is a 2x short SpaceX. And so far, we've had more interest on the short side than the long side, which is interesting because that doesn't normally happen. And it might not be, though, for the reason that people automatically expect, which is that people are outright bearish on SpaceX stock and are looking for a way to profit from the SpaceX shares falling. I think the more likely explanation, and given the fact that it's still very early days, we don't fully know, but the more likely explanation for me is that because this was an IPO, there are so many shareholders who are locked up. In other words, they can't sell their shares. And so they may be looking just to hedge exposure. And there are very few sort of tools out there for them to do that, particularly in an ordinary brokerage account. And something like SNK really fits that bill. So I think that that could be more what we're seeing, which would be unique to the SpaceX situation because it's an IPO and not just a regular, seasoned stock that's trading in the market. But that being said, it is still interesting to note that the direction of travel from investors so far has been in favor of the short versus the long.
That is quite interesting, and I'm sure we'll track closely how that develops. So, talking about SpaceX, there were a lot of concerns talk about the high valuation there. And I remember back in January, we had talked about how tricky it was at the time to find undervalued assets. So I wonder what you're seeing right now as undervalued that investors might want to take a look at.
Well, I think if you're talking about undervalued, you've got to talk about some of the assets or things that have sold off or that are out of favor. And, gold could certainly be in that category. Silver could certainly be in that category. So I think that's where, the type of thing you have to look to. I think if you're looking at markets, then again, value investors will point to stocks that are out of favor. But, clearly anybody buying SpaceX right now is not focused on the valuation. It's not a valuation story, just in the same way that, people that were buying Amazon, 10, 15 years ago, or people were buying Tesla, it was never a valuation story. It was always a growth story. And I think, again, that's the lens that you have to look through today. And back to my comment on earnings, again, remember that the valuation of SpaceX is keyed off of expectations. It's not keyed off of reality today. And so once SpaceX starts to season in the market, it will become much more subject to the quarterly earnings expectations that the company's setting versus the reality, of course, that the company's delivering. And that's when I think we'll start to see, the real performance come out. And again, if the expectations are dislocated from the reality, we could see a correction in SpaceX, of course, and or any other of these higher valued stocks.
Would you say overall that the average investor right now is more focused on growth than value? And is there a time or something that you think could make that change?
So yes, of course. I think that's been the way for the last 15, maybe even 20 years now. Value investing has really fallen out of fashion to a point where a lot of the most famous value, investors and people have largely, I don't want to say gone out of business, but really fallen out of favor. It's just tough because the market has changed. I think what sometimes people don't quite understand is that the difference between how we think about the value of a stock today versus how we thought about it 20, 30 years ago has just changed fundamentally. So now we value stocks based on factors that you would consider growth and not value. So the framework's changed. You look at a company now and you look at the patents that it has, the IP that it owns. These are all intangible things that, in the last sort of 20, 30 or 30 years ago didn't exist. And so we much more valued companies on the tangible assets that they had. So the framework has changed. And the one thing I would say that people are looking for is growth. And that's why, again, whenever there's a sell-off, and again, people will point to different reasons for the buy the dip mentality. But to me, it kind of comes back to what's the alternative? Because if the alternative means buying companies that aren't growing, and that is, so-called value investing, it's just not something that people seem to be that interested in doing. And so I think, it's people want growth. They also they want to believe in the future. So again, this is not really happening in sectors that are not, broadly speaking, tech related. And so people do want to participate in these stories, these momentum driven stories that are largely about the future. And that's the sort of the zeitgeist of the investor today. And it has been that way ever since the large tech companies really rose to prominence or dominance, in the large indices. And I think it will remain that way until something changes.
Great assessment of the current investor mindset. I will let you go. We can wrap it up unless you had any final thoughts that you would want to leave investors with, things that you're watching, things that are on your mind right now.
I think the main thing at the moment is, has been the talk of the SpaceX IPO and all the chatter around that. Seeing that sort of go off, very smoothly, I think is a positive thing for the market. And the setup remains positive. Towards the end of the year, again, providing inflation can stay in check, providing that some of the numbers, the elevated numbers that we're seeing right now, are more of a function of higher energy prices through the war than anything else. And as that starts to work its way lower through the system, we may start to see a change in narrative around interest rates as well. And if we go back to where we were at least at the start of the year, an expectation of interest rate cuts, and at least lower interest rates than we are now, then that provides, I think, the right macro tailwind for further stock market gains towards the end of the year.
Well, certainly plenty for us to keep an eye on. Thank you so much for coming on today to explain what's going on with precious metals, the overall markets. This was great.
Thanks, Charlotte. Pleasure. Thank you for having me.
Of course. And once again, I'm Charlotte McLeod with investingnews.com, and this is Will Rhind of Granite Shares.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.